coming today and for spending your day with us. We hope it's going to be a great conversation and we're going to be interacting with each other. Please write down questions if you have any. It's a small room on purpose because we wanted to have some of that conversation. So without further ado, I wanted to introduce Joanne Jenkins, the president of the AARP Foundation.
Good morning, everyone, and welcome. I wanted to start this morning by acknowledging two of our AARP Foundation board members who are with us today. Fernando Torres-Gil, who so many of you know, is a member of the AARP Board of Directors and the Associate Dean of Academic Affairs at UCLA School of Public Affairs, and also Neal Cutler, who's going to moderate the first panel, who is the Executive Director of the Center on Aging at the Motion Picture and Television Fund here in LA. So please welcome our two board members. As well, the directors of Leo Estrada, who I haven't seen Leo yet, but he'll be joining us shortly, and also Bob Pratt, who serves on AARP's National Policy Council and the California State Executive Council of AARP. And to welcome all of the staff. This is my first trip out to California since being appointed the president of the foundation. So I also want to thank all of the folks from AARP's state office who are here working with our foundation staff to put this event on today. In addition, the conference is being presented in conjunction with the New America Foundation, and I'd like to acknowledge Olivia Calderon and Maria Sotero from the New America Foundation, who are also here as well, and they're going to be taping today's panels, and we'll be posting them on the New America's website. So make sure everything you're looking up at intact as you're putting on the web today. So thank you all very much for joining in this session. I'm delighted that we're all here together in Los Angeles to address this topic. We're here not only to generate greater awareness, but to apply our best thinking and take effective action that will build and sustain a greater financial security for older Americans who are underbanked. This is a very fitting place for us to meet. Almost 450,000 households for people who are 45 and older here in Los Angeles area are underbanked or unbanked. Fortunately, there is a growing energy and creativity and commitment on the subject across the many different sectors of Los Angeles. You're moving this issue from the shadows of neglect to what we call the sunlight of solutions, and I'm glad we're here in the city for a couple of other reasons as well. Los Angeles is the targeted community for AARP Foundation, and it's also a place where AARP will hold its annual member event next September 22nd through the 24th, and we hope that all of you will be here with us. This past year's event was in Orlando, and we had 22,000 people who showed up for that, so we're very excited to be here in Los Angeles in 2011. And last but not least, here in the city, where AARP's remarkable founder, Ethel Percy Andrus, became the first woman ever to serve as a principal in the state of California, and she was a high school principal at at Lincoln High School in East LA. So Los Angeles is very near and dear to all of us who work in the Los Angeles area. This is the city where Dr. Andrus honed her skills and harnessed her sensitivity to the plight of older adults in profound ways that have made America a much better and more caring, more inclusive country. You might say that AARP, like many memorable American moments, was made in California. One day, more than 60 years ago, in a town just outside of Los Angeles, Dr. Andrus, our founder, was looking up at one of her old retired friends who was a retired teacher. She was shocked to find that this former teacher was living in a chicken coop, living there because she couldn't afford affordable housing and did not have health insurance to make ends meet. Dr. Andrus did just get mad. She took action on behalf of retired educators who had no health insurance and terribly inadequate pensions. She founded the National Association of Retired Teachers, and then AARP. I mentioned this story not only because it took place near here, but because it goes to the heart of what we're about in the AARP Foundation. Dr. Andrus saw her role as not simply to spotlight problems but to create and carry new solutions that would lift people's lives. Today at AARP Foundation, we work to create solutions for vulnerable people who are 50 plus that help them secure the essentials like food, housing, income, and food, and to make that personal connection to deal with the issue of isolation that's affecting so many of our 50 plus low-income older persons. We focused on the needs of low-income vulnerable people, and we work with groups and individuals in Los Angeles and in communities across the country to help them meet their needs. Over 33 million low-income women and men aged 50 and older and above lack adequate financial resources and are at risk of failing to meet one or more of their basic needs. At AARP Foundation, we're building relationships with banks and credit unions at the community level. We're putting resources where our rhetoric is. The foundation has a program-related investments at Broadway Federal Bank, a bank that serves customers in the underserved Los Angeles community. And Hebe Anderson of Broadway Federal will be our lunchtime speaker today, so I hope that we'll have a wonderful opportunity to hear more about that. We're helping to bank the unbanked through our partnership with Bank of Los Angeles. We're particularly supported with the Bank of LA's outreach through promotores, the community-based leaders who provide financial education and guidance to help the unbanked open free or low-cost banking accounts, establish credit, and build their financial security. There are neighborhoods in this city with a troubling ratio of alternative financial institutions to banks. In Boyle Heights, for example, banks are outnumbered by more than 4 to 1. In Southeast LA, the ratio goes up to 5 to 1. Low-income residents in Los Angeles pay a steep price for this imbalance. We're helping low-income older adults move beyond cashing outfits and carrying around large amounts of cash, and we're constantly looking for ways to accomplish these goals. I'm pleased to announce that just last week, AARP's board approved the foundation putting in the market the AARP Foundation prepaid debit card to increase financial security among low-income individuals. And this is a first for the AARP Foundation to come up with a product that we hope will move the market and set in place some standards around costs that help support the low moderate income. We see such a card as meeting a vital need and moving the marketplace. We see it as an important step away from predatory lenders and to all the financial burdens that they impose. This, we hope, will be a reloadable prepaid debit card that functions like a debit card affiliated with a bank. Cardholders would load funds on the card and only be able to spend available balance, so the risk of overdrafts would not be there. And to get a good sense of the value of such a debit card, it's important to keep in mind that the estimate by the Center for Financial Services and Innovation estimated that low-income households pay about $700 per year for basic banking services as getting check cashing and purchasing money orders to pay bills. That's money that these consumers could use to pay for food or transportation or health care or other basic needs to help their families meet their needs. This card would also include a savings feature, enabling cardholders to save a portion of their funds automatically or through the transfer of funds between accounts. This card will also make it easier to manage their money well and protect their assets, and we're going to make sure that this prepaid card comes with strong consumer protections for the customers. We think this kind of debit card will have an especially positive impact on diverse communities, since non-white families are 4 times more likely to be unbanked than white families. And 35% of all Hispanic households are underbanked in this country. We see this prepaid debit card as a natural progression from the report on the underbanked and unbanked that the AARP Foundation and AARP's Public Policy Institute issued earlier last year, which you all have a copy in front of you on the table. And that report built upon the data and research from the Center for Financial Services Innovation. That's the approach we've taken to increase financial security. That's the path we're taking to help combat hunger by putting more money into the hands of those who need it. Nearly 6 million older adults in this country face the threat of hunger every day. At the foundation, we've also joined with Hendrick Motorsport and NASCAR superstar Jeff Gordon on the Drive to End Hunger program. We'll be raising awareness, we hope raising funds, and pursuing long-term solutions around the issue of hunger as well. By bringing cause-related marketing to the NASCAR circuit, we're taking an unconventional course. From NASCAR to neighborhoods, our role is not to duplicate, but to innovate and to collaborate with others to make a lasting difference in the communities that we're all trying to serve. At the foundation, we know that whatever road we've taken, we have to be careful listeners. We're eager to get your insights, to share information with you, and to move forward together to help the low-income older Americans maintain and gain or regain their financial footing. On each table, you'll find note cards that we encourage you to fill out. We'll post these note cards on the wall before the end of the event. Your answers will help make this conference as productive as possible. They will point us towards our next steps for all of us to any new solutions as we help to move the low-income older adults. One housekeeping detail, when you ask a question today, please wait for the mic. That will make it much easier to be fully captured in the proceedings that we'll be posting on the web. We thank all of you for taking part in this conference and for taking a leadership role on trying to address this issue of financial security for those who are low income in this country. And now I would like to introduce again Neal Cutler, the Executive Director of the Center on Aging at the Motion Picture and Television Fund, who will be our moderator for the first panel. Among his many accomplishments, Neal is a noted authority on financial literacy and on the connections between aging and business and finance. So, Neal.
First things first, turn off your cell phones, please. Probably already have it. That doesn't hurt to remind you. Thank you, Joanne. You mentioned in your remarks, I picked up the Los Angeles would be the place for the sunlight of solutions. I think it's a marvelous phrase. But I apologize to you as a Washingtonian that we have a cool down to 78 degrees today. I bet you can't wait to get back. Well, thank you. It's my pleasure to be the moderator for this morning's discussion. This first part of the discussion of the challenge of meeting the needs of low-income elders. This will be a very quick introduction, or as a Texas friend of mine says, it's a bird's eye view, and the bird is flying fast. First things first, a couple of definitions, but you'll hear some other definitions later. A couple of definitions. Unbanked, having no current checking or savings account. But underbanked describes men and women who have a current checking or savings account, but for various reasons they also use non-bank providers of financial services, such as non-bank money orders, check cashing services, payday lenders, or even pawn shops. So in this context, why are you and we here together today? It's to work together to inform and move business and marketing opportunities, and to work together to inform and move social policy where that can be relevant. So, why are so many people, especially elders, unbanked and underbanked? There are many reasons that keep people from using financial services through banks and credit unions. Let me just, in the introduction, I don't take some time from our speakers, let me just mention 3 examples. First, there's a distrust of these kinds of institutions on the part of low-income people. Secondly, as Joanne said, there's a lack of access to these kinds of institutions in many communities where few banks or credit unions are even available. The third example, there's the perception, often it's incorrect, but the perception that banks are not for me, that I don't have enough money to open up a checking account. And often this is a false perception, so we have to work together to find ways to correct those kinds of misperceptions. In this session, this morning and throughout the day, we will get further information about the preferences, the attitudes, the misperceptions, and behaviors of the unbanked and underbanked consumers. And finally, what are some of the negative consequences of being unbanked and underbanked? We're talking about elders who are already disadvantaged because of their low-income status. Again, three examples of the negative consequences. The first is the increased costs of using financial institutions like pawn shops and check cashing services. One report estimates that over the course of their lifetime, unbanked men and women can pay as much as $40,000 in fees just to cash their checks. That's $40,000 that they pay just to get the money they've already earned. A second negative consequence of being unbanked, it reduces a person's ability to get credit through which they can get resources for the investment for assets later. And the third example, here's an interesting 21st century challenge for us. Many government payments are being converted to digital electronic payment systems. For example, by 2013, all Social Security monies will be received by way of electronic transfers. This means that it's even more important for us to ensure that everyone has access to safe and sound and sustainable financial accounts. And so in this opening session this morning, we have two experts to provide context and research to guide our conversations to follow. First, with a national portrait of the who and the what and the why of being unbanked, is Vivian Vasallo, Senior Community Director of Community Innovation Programs at the AARP Foundation. And second, bringing us back locally to the view of Los Angeles, is Tellalian, Director of the research firm Emerging Markets, which specializes in connecting low-income neighborhoods and businesses. Ladies and gentlemen, please listen to them closely, write down your questions, and we will have an invigorating question and answer session right after our speakers. Vivian, the microphone is yours.
So thank you, everyone. I always like to preface my remarks by saying that even if you can't see me over the podium, hopefully you can all hear me through the microphone. So thank you all for joining us this morning. It's always exciting to be in Los Angeles, especially as people have alluded to, the weather back home is about 20 degrees. So certainly welcome being here in California. And I just wanted to give a little bit of context. When the foundation started looking at the issues of financial services and innovation, I joined the foundation in 2008, and it coincided with the Center for Financial Services Innovation, CFSI, sharing a report that they had done on Underbanked. And so I met with Jennifer Tesher, who unfortunately is unable to join us today because she's snowed in Chicago, but she certainly sends her regrets, and I know really wanted to be here because we work very closely with CFSI, not only in looking at data and looking at the needs of older underbanked, but also in, as Joanne announced, looking at prepaid cards and other alternatives that we can provide to consumers. And part of bringing this session together is really bringing together thought leaders, market innovators, and policy people to look at the solutions that we need to solve this problem. When we started looking at what do we need to do to solve the problem, we realized we needed to take a step back. We needed to look at the data because we really didn't know what was the scope of the problem, why were people underbanked, was it by choice, was it lack of banks in their communities, and so we worked with CFSI again to really outline for this market segment. And the way our data is segmented is looking at 45 plus. So you'll see me making references to 45 to 64 and then 65 plus. And some of the things that we're going to go over this morning. Hopefully through the data that I share with you, have a better sense of who are the older banked, un and underbanked in the older adult population. What are the reasons for them being underbanked? How are they transacting? We know that they're using payday lenders and check cashers and even family members for their financial transactions. And then finally, what are the solutions to their needs? And that's really going to tee it up, Daniel and I, as we share some of the data for the next sessions to really look at what are the solutions and how can all of you who are in this room, who are policymakers and philanthropy and nonprofits and people from the marketplace to really talk together. So we really want you all to connect and take this data. I always say we don't want to create reports to have them sit on a shelf in your office. We really want you to take this report and take this data and come together. Just before I jump into some of the data, I just want to get a quick sense for who's in the room. You guys raise your hand if you are with a policy organization or if you're a policy maker or involved with policy. Great. And then how about those of you who are in the philanthropy field, so with the foundation or related to funding communities? Great. And then how about those of you in the marketplace, those of you with a bank or credit union or a financial institution? I know we have a panel in the afternoon for that. Great. And then the last audience, I guess I would hope would be those of you in the nonprofit sector, working directly with the community and those serving. Great. So hopefully you were looking around and as you saw who was raising their hand saying, you know what, I need to connect with a policy person or a market person, and who's there. So again, just briefly, as I said to Neal, our moderator, I am not the statistician person. I'm the Public Policy Institute. Public Policy Institute was the one that did the survey, but just for those of you interested in mythology, it is based on CFSI's data, and it was a national survey conducted by Experian, and the way we have the age groupings are 18 to 44, which for the benefit of our conversation today, we'll call the younger set, 45 to 64, and then 65 and over. And we really cross-tabulated. We wanted to know not just what the older set, how they bank, but really what that means by income, by race and ethnicity, and their employment status. So, as my team will tell you, I like to give a lot of pop quizzes. So I think that if, every day don't you wake up and think, am I going to learn or do one new thing today? So I just, if you know the answer because you've read a report, please don't blurt it out. But just sort of, what are your guesses? Joanne gave us the insights to LA. So we know that in LA it's about almost, 450,000, 500,000 un- and underbanked adults over the age of 45. So what do you think that problem looks like nationally? Do you think it's 3 million, 7 million, 13 million, or 17 million? So any thoughts? 13, 17. Yeah, so the answer is 17 million. There are almost 17 million underbanked and unbanked people over the age of 45 living in the United States. And if you're wondering, why is the AARP Foundation convening a group on un- and underbanked people? Why do they care about income financial services? This is why, because this is really just one of, I would say, what we call the unacceptable facts. We have 6 million older people living in hunger in this country. That's unacceptable. There are over almost 17 million people that are un- and underbanked, and as Neal said, these are people who are using their hard-earned dollars to pay for fees rather than food and medicine and housing. So we really want to tackle this problem and meet the solutions. So again, I think some of the data shows what conventional wisdom holds. For older adults, we tend to be more banked than the younger set. And in fact, when you look at the data for all over at age 65, not breaking out by race or ethnicity, you find that almost 75%, 3 in 4 consumers have a bank account or have used a financial institution like a bank or credit union to do their services. And so I would say if you're in a bank or credit union and you look at that, you're not looking at the needs of the unbanked, you might want to think about the longevity trends in this country, and that if people are living to be 20, 30 years longer, that there really isn't a lot of product innovation around the needs of banked individuals from 65 to 90 or 95, which is something that we're seeing people live to that age. So again, if you're doing nothing else but looking at the already banked, I think there are a lot of opportunities to look at older adults as a population. But our focus today is really on the underbanked, those 17 million living in the country, and those 500,000 living here in LA. Sadly, I think the story for older underbanks mirrors that of all underbanks, and that this is really a problem that affects especially African American and Hispanic families and households more so than their white counterparts. And I was sharing, we have a colleague, we have an African Outreach Associate State Director, Sharian, with us today. And I shared with her, I said, a fourth of African American individuals between the ages of 45 and 64, only 1/4 have access to a checking or a savings account, which means that almost 3/4 don't. And so this is really an issue that we need to look at because, as Neal mentioned, when they're not banked and they're using their money on fees, that means they're not saving for retirement and they're not really living for a secure future. And while over 80% of white adults in the age group 45 to 64 having a checking account, less than blacks and Hispanics do. So what are the reasons? Neal outlined some in introductory remarks, and here's the data to show it. The number one reason that these communities are not banked, underbanked, according to our study, was that they felt that they didn't have enough money for the accounts to be useful, and that the current products and offerings maybe perhaps weren't meeting their needs. Again, it's an education aspect. Do they know the information that they need to have in order to be banked? The second is concern of misuse of personal information. And the third is hidden fees and charges. So this really, this fear stems from a lack of trust in their financial institutions. And that's, I think, something that's very different from not having a bank in your community or not having the right product and service. What the reasons that we're hearing from the data is if you can help build that trust, you can potentially reach these consumers. Now, looking more closely at the data along race and ethnicity, the data reveals that Latinos and Blacks cite different specific reasons. And just looking at the African American community, over half talk about concern about misuse of personal information. So if your target audience is a Hispanic or white audience, then this is not necessarily as much of an issue as it is in the African American community. So my question to all of you is, having this data, how do you use it? How do you gain the trust of that consumer? How do you partner with organizations who have the trust? So who has the trust of that person? Is it the faith-based institution? Is it the community organizations that we have represented in this room today? I think if I were a banker sitting in the room and I knew that, for example, Rigo, who was with St. Barnabas Senior Center, who's here, has a trust of his community, I'd probably want to have a meeting with him to talk about how can we work together to gain the trust of your clients so that we can get them banked. The other thing is grocery stores. In fact, almost half of underbanked individuals, again in this 45 to 64 segment, cited supermarkets as their preferred institution for financial transactions. So again, we talked about hunger. I think it's interesting as we move forward with our strategy of how we integrate across our different issue areas. But we don't have any groceries in the room today. We don't have any supermarkets, and we see them as a solution for hunger. They might be a solution for financial security as well. So, again, in the dialogue today, we'd love to hear how you're working with, grocers and perhaps some untraditional partners in this. Now, shifting gears a little bit to borrowing behavior. We know that among the underbanked, Hispanics over the age of 65 plus were the ones most likely to have borrowed in the last year. And for this age group in the low-income range, what we're seeing is, and this data again was from 2008, but what we're seeing even in trends in the last year or two is that there's repeat borrowing, and they're doing this because they're unable to meet their basic needs. In fact, when we broke out the data for 65 plus, when it's broken out by income, those that are making the least amount of money, under $10,000, borrowed at a rate of nine times in the last year. So they were just in this perpetual cycle of borrowing. And I have to say, when I was reviewing that and coming out to LA where our founder started AARP, where she's from, I just thought, this is not the vision that Dr. Andrews had for a future society where people are living with dignity as they age. And we certainly don't want that chicken coop story replicated in the 21st century. So it really struck me that this small dollar segment where most people are borrowing just $500 to $1,000, which is not a lot of money for many of us, but for these populations, it really is making the difference of retiring and living with security or living in poverty. And I think if we can think about interventions in this space, we can really provide a solution to some of them. In fact, my colleague who worked very hard on this event, Donna Ortega, is in Northern California today participating in a dialogue around small dollar lending. And again, what we talk about is how we can insert the lens of the 50-plus population, because I think if we weren't at that conversation in Northern California today, the small dollar loan conversation would really be geared at younger folks and young youth and family. And what we really want to say is, look, we have over half of Hispanic men and women borrowing almost on a monthly rate in predatory environments. We want to look at how these solutions are affecting our population. Where do they turn to borrow? Where are they getting their money? I think, again, I'm Hispanic, so for me it's wasn't so much of a surprise to learn that they're turning to their family and friends in our family and in many communities of immigrant descent. you're looking at a different way of borrowing money. You're looking at these lending pools that some communities have. And this is where they're turning. And I think, again, this, always looking at the problem as a solution, an opportunity for a solution. We're seeing a lot more in the peer-to-peer lending space. And how can we use that behavior of borrowing from family members or friends in ways that can build credit and can be non-predatory? I would also encourage us to look at what are some intergenerational opportunities. If we know that people are looking at family members for financial interventions and security, are there features that you can have in an account that might be family-oriented? And again, we look at the prepaid card, which doesn't have a lending feature on it yet, but we look at the opportunities to save on that, and so where are the opportunities in other products around borrowing? I think there's some people here today from the FDIC, and the FDIC has done a great job with their small dollar loan pilot, and I think what we look at is how does that affect, again, this segment of the population. So here we look at between the income level of $25,000 to $50,000, again in the age range of 45 to 64, that people are looking at a variety of different sources for lending. The personal loan, as I mentioned, is by far the largest. And if you look at on the far right, that blue high bar, it's almost 48% for personal loans. But what we see as the second and third reason are home equity loans and line of credits. And again, we know that in older communities, homeownership rates are higher. This is perhaps an opportunity to steer them in ways that they're not stripping well from their asset, their biggest asset, which would be their home. Again, I mentioned that the family and friends, but another place that they're turning to, which I think is of note, is auto title lenders. We're actually seeing, again, trends that this is an increase, especially in places like Arizona where payday lenders were shut down. What we're hearing is, anecdotally, is that the very next day, Bob's Pawn Shop or payday lenders shut down, and now it's Bob's Auto Title Lending. So and these products are even more predatory than the regular payday lenders, with APRs that are through the roof. And again, you think you've solved for one problem by maybe shutting down payday lending, and what we're seeing is that there's an increase in auto title lending. Almost a third, in fact, of the population over the age of 65 have used an auto title loan. And again, this data being from 2008, if I had to guess, I would easily say that number is higher today. And I wanted to share with you a story that we had from someone who came to us in Texas, at AARP, Texas, because they used an auto title loan, and I'll just share with you this quote. They say, I went to a car title payday loan company to get a $500 loan on title to my pickup truck. And I used this truck as my work truck. I paid off the loan twice. The last time I got behind by a week, as a customer had not paid me. I'm a self-employed landscaper. I called the auto title company to let them know that I would be late, and they added $100 to my payment for being late. They also had already called a repo company to pick up my truck. I offered to pay something, not all of the payment, just show that I wanted to pay and had intent and would pay the loan off. And they said no. So as a result of this person lost their car, their truck, which was their mode of being for their employment. And they came to us for help. And I can tell you that we have many, many stories like that. And we're seeing more and more of that. As AARP works with our state offices, they turn to us for help. And again, why we're here, why we're doing this, why we need all of you in the room to help is we don't want this to continue. And we have too many stories like this. And when we think about what does that 17 million number represent, it's people like that gentleman in Texas who are really losing their livelihood because of some of these predatory products. So now that I've painted this dire picture of the underbanked community and all of these older Americans who are victims of some of these products and services, what are the solutions? We did something unique in this report, and that is, in addition to working with our Public Policy Institute on policy recommendations, we as the foundation have a unique role to play in the philanthropic and nonprofit sector. So we added some recommendations for philanthropy and for nonprofits, because really what we want to do is encourage everyone to be part of the solution. So you'll hear in the next panel some of the policy solutions, but I just wanted to talk a little bit to some of the funders in the room and some of the nonprofits in the community, and also some of the marketplace providers about some of those solutions. The first being product offerings. Are the products really meeting the needs of the people that we serve? Are they helping to build credit? Are there second chance accounts for people who maybe messed up in the past and need access to, to credit again? And then what are the small dollar loan options? Because again, we see that the trends are that they're borrowing in the $500 to $1,000 range. And then partnerships and collaborations, looking at non-traditional partners. I mentioned grocers. Emerging Markets is in the room, which was one of our partners here in LA. They are a triple bottom line company or double bottom line. The sense is that there are other partners, and it may not always be a grant. If you can't grant to a for-profit entity, you can certainly enter into contracts with them. So there are alternatives for foundations to work with not just the nonprofit sector, but with the financial and the for-profit sector as well. The other areas I think that we see as solutions are grant making. There is a lot of need for especially evaluation and technology for organizations that are working around solutions in this. So thinking about how you can perhaps invest in some nonprofits around that. The power of convening. I mean, we're here today bringing all of you together and have invited some great speakers to talk about this issue. I certainly hope this isn't the last dialogue around this, and I hope we're not the only ones out there putting it forward. I'd love to be invited back for a session that maybe some of you all are hosting or a dialogue, because we know that it has to be ongoing, and that especially the local foundations really have a lot of power to convene some people who aren't here today that maybe we missed being a national organization. Putting your money to work. Joanne talked about how we have invested through program-related investments, PRIs, in a local bank. We've done that in some of our other communities across the country. I'm a big fan of PRIs. I think there's a lot of capital that's needed for banks to maybe perhaps go out there and do some of this work. You need to have that catalyst investment. That's a role that foundations can play. When you pull those dollars together, that's really significant for a community bank or even a large institution to have a model. There's a real need for that area. And then finally, what we call practice what you preach. You're all employers. Your organizations act as economic engines in their own communities. Is your staff banked? Is your staff making retirement decisions and planning? Are you holding them accountable? I can tell you that at AARP, when I started, I didn't even have a choice in participating in the 401k plan. It was automatic. So AARP is one of those organizations where we try to practice what you preach. In fact, I'll even add lately around healthcare, we're being incented to be healthy. And so they're going to really be looking at if we're smoking and overweight, that they want to incent us to positive behavior. I mean, so I think that looking at closely at how we participate and how our staff participates in some of these financial services is indicative of how we can then have others to do that. So again, just kind of in conclusion, hopefully I haven't gone too much over my time, but 17 million un- and underbanked people over the age of 45 is really unacceptable, and we really want to see that number come down and hopefully come down to zero one day. We see disparities for older blacks and Hispanics, and opportunities for banks and credit unions with over 75% of older people being banked or having had a banking relationship at some point. It's an opportunity for you to connect, more so than in the younger. So the CFSI data shows that younger people don't have those connections with banks and credit unions. That's a little bit different for our population. And then finally, the opportunities to innovate. I think California and LA and San Francisco in particular have really been national leaders in innovation around financial services and products. And so what we hope today is that you think in that way, that you look at the aging lens and how the needs of people over the age of 45 are being met. So that's it for me. We are, online as well and tweeting today and sharing information, and hopefully you'll follow us and continue the dialogue.
Ask me to reintroduce Daniel Tellalian. Is that what you call your attorney as well as researcher?
Yes, recovering attorney.
Recovering attorney. Like several others in this room, he's bi-coastal. He's in Los Angeles, but he's worked in Philadelphia. And you're a graduate of the University of Pennsylvania. Daniel.
first, I'd just like to say that I'm thrilled that our AARP Foundation is actually stepping up in a leadership role in the financial services space. I think it's probably one of the better kept secrets, especially here in California. So to see AARP as a leader and convening us today is most appreciated, and we are grateful partners going forward. I'm going to do 3 things really quick here today. I'm wearing a hat as a partner with Pew Charitable Trust, who's made a substantial investment in market research, specifically in the banking arena here in low-income Los Angeles. So my goals are really 3-part here today. One is to make you aware of that research and what's going on, and what's come out, and what's going to be continuing to come out. Secondly, I'll give you some real quick, within time constraints, a few top-line findings of what some of the early research is telling us. And then third, I took a quick cut at the older segment as well of that same raw data, so that here's an alternative Los Angeles lens on the senior population. So I'll do a little bit of each of that today. Pew Charitable Trust has made a substantial investment in primary market research here in the LMI Los Angeles area. It was at a level, I think, that was extraordinary by both public sector, private sector bank, and philanthropic sector comparisons. So there was a lot they wanted to do. There was a lot of reasons why they made that investment with a level of rigor. So I wanted to run through why Pew chose to do this. I think it was pretty important. First and foremost, there hadn't been a substantial level of rigorous market data for Los Angeles neighborhoods, where probably the dubious American capital of the unbanked here, in terms of the sheer scale of the problem, nothing compares to Los Angeles. But there's really a lot of applicability when it happens here in Los Angeles. When we talk about our unbanked and our immigrant assimilation, we have enormous amounts of foreign-born individuals who are underbanked, but they've been living here for 10, 15, 20, 25 years. So what we have and have not done here in Los Angeles is extremely applicable to markets across the country, what's happening in Atlanta and in Raleigh and in Michigan. And because of that, we believe that some of the case studies and some of the lessons learned here are not only really great to shine a very bright lens on LA and let us do the work that we do trying to work on our particular problems, but to also provide some insight at a national level. And got that and was interested in that. They also wanted to invest in a more rigorous level of market research than typically exists. I don't want to do a boring methodology slide, but let me give you maybe about a minute on what we do. 2,000 households were randomly selected across 8 neighborhoods in door-to-door surveying at a very extensive and borderline invasive level that had to be properly incentivized to do so. In the world of market research that we're in today, really, telephone and internet interviews are really the cost-effective way of touching people. When you're talking about people who don't have landlines, are not computer savvy, and quite frankly, oftentimes are not looking to be found, those types of sampling procedures do not accurately reflect the types of populations we're really talking about here. But the problem is, it's very high touch and very expensive to get to those people, to literally generate an address and go find that person no matter what, and then comfort and incentivize them in a way that you can ask a number of financial questions. I'm very proud that Pew decided that that was worth the time to do in Los Angeles. Some of the initiative for making that happen came from a gentleman by the name of Matt Fellows, who spent some time at Brookings and some time at Pew and is currently running his own company in this space. Going to, quite frankly, banks and confronting a number of presumptions about the low-income market and about the underbanked that were never backed up by any level of rigorous market research. And so he spent some time professionally saying, I'll bring that research. I will find a way to bring together the best-in-class research available in the LMI market, and I'm going to do it in LA because I think that's something that's extrapolatable to a lot of other places. So we appreciate that level of rigor that was brought forward. And I think the data sets that we have are extraordinarily complicated, more than we can deal with today, but are a really good source of data that can be mined over and over going forward. So in terms of the objectives, really informing the retail banking industry with detailed profiles, putting our research up against their investments in research, and saying, no, actually, I think this is the profile of what you're looking at, and these are the the low-income segments around banking. At emerging markets where we really are 2.5 bottom line, and really work within banks to show them how they can tactically, profitably, and responsibly touch low-income markets. This is really our point of most interest, is really using this data to find out how we can operationalize it in the field of retail banking institutions. So we're really excited about that. Also look to inform the national and state debates on financial services and financial justice. I think that's really Pew's sphere of influence in Washington, D.C. Elaine Constantine, who's the director of this project, is a former Capitol Hill girl, and at the end of the day, she's presenting this type of data in committees and with electeds to try and move the debate and get a little smarter and more nuanced there. Bank on. This was also intended to, there's been a lot of anecdotal discussions about the success or lack of success of bank on programs. We're going to do it with data. This is a longitudinal study that went into the field prior to the aggressive rollout of the Bank on LA campaign. It's also resurveying the same families afterwards. We'll be able to bring data to bear to say what happened, what was the awareness, what were the changes in financial behaviors going on. So we hope to, among other things, talk about the efficacy of the Bank on programs that I think are important to a lot of us, and see what we can improve and inform that for a number of other municipalities who are rolling that out. And then finally, just for our academics and for statistical reasons, we're looking at the predictive variables in financial behaviors and health conditions. By having a longitudinal study with multiple points of data, we're allowed to run a level of multivariate regression analysis in a number of ways. We can start saying where are the correlations, how can we lever one driver that will affect people's financial behaviors. So we're looking to do that as well. And so that we're trying to get all that done, and we're halfway there, so I'm going to do a little review of that. 8 neighborhoods in LA. We use a methodology called random locational sampling, which means we pick 8 neighborhoods, and then we, within that, randomly select addresses and go find those people. It's a very robust method. The 8 neighborhoods real quick: Boyle Heights, on the East Los Angeles border of the city of Los Angeles, in the northeast San Fernando Valley. Westlake Pico Union, an immigrant enclave near central Los Angeles, just to the west of central Los Angeles. Vernon Central, South Los Angeles, your classic Central Ave community. Baldwin Village and Leimert Park, an almost middle-class neighborhood in southwest Los Angeles. Lincoln Heights, home of Lincoln High School. In North Los Angeles, one of Los Angeles' oldest suburbs. The South Figueroa Corridor, which is the commercial corridors and attached residential tracts just south of USC in South Los Angeles. And the community of Watts, which is further south of South Los Angeles, and has a distinctive community itself. So that's where we were looking at 2,000 households within here, which is a substantial population, randomly selected. It allows us to slice the data in a number of different ways and still have statistical validity in making our conclusions. These were picked for a number of reasons. 4 were the initial pilot neighborhoods for Bank on Los Angeles, and 4 considered control groups. There's a taxonomy within these neighborhoods as well, where they're at a number of different economic trajectories, which allow us to extrapolate as to what types of conditions happen in what types of neighborhoods. Some, as I said, are poor low-income neighborhoods. Some are almost middle class. Some are sort of working class neighborhoods. Some have gentrification pressures. All that makes a difference. We're allowed to. We've done tons of internal profiling, which I can't go through today, on each of these neighborhoods, where they're going, and what the populations are doing. So let me run through and give you a quick outline of some of what we're seeing in these neighborhoods and the unbanked population. This is a split. Pretty quick about the methodology. We did not intend to do a census of the unbanked or underbanked in these communities. I think there's enough data on that, and certainly here in Los Angeles, we're willing to acknowledge the population. What we are looking to do is compare the behaviors and the tendencies of the banked with the unbanked and look for levers. So we took roughly 1,000 unbanked and 1,000 banked families as our quota, and we compared between them. These are the banked and unbanked pie charts. We sub-segment them. In the banked population, a full 37% of the bank population also regularly uses alternative financial services. That's a number well in excess of, for example, the FDIC estimates for the metropolitan area, and really is one of the most interesting numbers. A lot of people refer to these, and the A part is underbanked. Don't like that terminology as much. I don't believe that their underbanked is just getting to bank. I truly believe that they are a savvy crossover segment, that they are optimizing between, in terms of pricing, liquidity, and convenience, they are optimizing between alternative financial service providers and banks. And so I would offer up the term crossover and say they're bigger, they're up for grabs. And I'll tell a little bit about sort of some of their tendencies, but that's really one of the subsegments of the banking population where I think philanthropy policy and the private sector need to be concentrating their efforts because they're up for grabs. On the unbanked side, certainly a large alternative financial service user, people have been using it for a long time, are very satisfied. We should not kid ourselves that people just fell into the check casher, they chose it. But more interesting perhaps is the cash economy segment, the sheer unplugged segment here in Los Angeles that are not transacting through any sort of provider, that are working exclusively in cash. It's larger than the FDIC sample, although they were pretty close in terms of estimating the LA area that we have. But still, if we think of, and I'll throw out my own numbers, I know we all have ours, if there's 10 million people in the Los Angeles County area, and I'll make the bet that there's a million unbanked individuals in this area, we'll talk about the larger area, that adds us to about 300,000 people simply in the cash economy. Not paying any taxes, not voting, not really engaged. There's a massive economic development play here in Los Angeles, just trying to engage those issues. That's not necessarily an education issue, although in part it's an assimilation issue, and we get caught up a lot of times in immigration rhetoric. But those are your breakdowns, and I would say from a economic development consultant's point of view, the two minority segments there are, we spend a lot of time in the bank versus check casher sort of space. The crossover and the cash economy segments, I think, have massive opportunity. And I think it's where we should spend a little of our sort of intellectual horsepower. Quick top line findings. Water here. The data set is massive. There'll be reports here. You can look through some of what's there, and we continue to manage and work the data as it is. But these are just a couple of the headlines that I'd like to share with you. One, the notion of satisfaction and trust. The banks are happy and trust their banks. AFS users are happy and trust their AFS providers. There is no real difference. What you're using is what you're happy with. So some of the moral arguments that if people just knew better or had an option they would switch, not necessarily the case. Don't kid yourself. Now the crossovers are agnostic and really optimize at a financial as at a convenient level. So with that segment, I think they're up for grabs. The cash economy segment is more predisposed, though they don't use the banks. I think they buy, for the most part, to be American dream, the notion they see themselves as banking, although they're not plugged in, again, in education and assimilation. Bank accounts correlate with successful savings. Our banks save better. They're more effective at saving. They're able to pay their bills and put a little something aside. It really is more difficult to take cash and put it in a mattress and actually keep it there. This is actually even controlling for income and education and a number of things that correlate with bank status versus non-bank status. But still, just getting that account improves your chances of effectively saving over a period of time. So there's value in what we're doing. Third, your form of income influences your banking status. This is potentially the largest lever. By definition, if you're direct deposit, you have to have a bank account. I think, to Vivian's point, Social Security moving towards a mandatory automatic deposit makes a big difference. The U.S. military has done this and absolutely decimated their unbanked ranks, which are particularly high. You have to have a direct deposit now for the U.S. military. There's a number of places, but when we talk about policy solutions for our employers and for various folks who are making payment, it's the best thing you can do. When people are paid in cash, and if you're unbanked, very rarely does that money actually get into any sort of a mattress, coffee can, bank account, anything. Check, much better opportunities there, especially within the bank and sort of that tweener. But this is really a policy place where we control the form of payment. We have a much better chance of directing consumers into bank accounts. Customer longevity, profitability among the banks. I'd like to debunk right now what I hear a lot of times amongst my clients in the banking industry. The LMI segment is not profitable. Untrue. They generally have one bank account, or one bank partner. They generally have it for a longer period of time, between 5 and 10 years. I won't get into the numbers, I'm not going to do QA, but for a long time, they're generally using about 5 to 5.5 revenue-generating products. So the whole notion, like we have to juice people for fees in year 1 because they won't be around in year 2, to me is not backed up by the data. I would have that conversation in a banking board of directors meeting. Here in LA specifically, most of LA unbanked have never had an account. This is not a check systems issue here in Los Angeles. This is a case of first impressions. This is an assimilation issue. I think it's about 63%, I believe it is, of the unbanked have never had an account. Another 22% are unbanked by choice, the title of the report. These are people who have not been kicked out of the banking system, generally have had a bad experience, often around fees or customer service, and have chose to leave the banking sector. So these are people who, and it's only 9% that are actually not allowed back in the banking system. So it's not necessarily a check systems issue, it's a customer service and media market issue. And then of course the assimilation piece. Crossovers, as I said, they optimize. They use alternative financial services regularly and tactically, at least once a month for the exact products that they know. Typically remittance, money order, bill payment, check cashing, things that are not able to bank. The banks are not reaching them correctly. Some of the most interesting operations out there are hybrids, which are involving check cashing and transactional operations with asset building and depository functions. And those are some of the places where you can truly see a crossover just going off the menu and optimizing their products. That exists. Finally, the cash segment is our best savers. When we look at it, when you look, they have the lowest income, we're generally the most vulnerable. The cash economy folks in our population save aggressively, but they save by remittances. They will remit more than any other segment in the population, and they will send it abroad. There's an opportunity there, and I believe you don't need to teach the sort of cash economy segment how to save. They're doing it and sending it home. So that's not the issue of saying saving is good. It's giving them a vehicle that meets their needs. Older unbanked, really quick. So we took a quick slice, and some of the things I would say that certainly back up with Vivian and AARP and CF Society told us. One, it's an important segment, both from a public policy point of view and a market development perspective point of view. Over 1/3 of our sampled population is unbanked. If you count your crossovers and your cash economy users overall, 56% of this population is unbanked. So we always think of LA. LA is a young city. When we think about the change in the banking issues, we think about our younger and our immigrant populations. Yes, important populations, but to sort of not focus on these older populations is a mistake. And so I'm really glad that AARP is sort of shining that light on that case. I would also say there's still very real income here. Mind you, when we say older here, I sliced it at 45 and older, which hurts me personally that 45 and older is now older. But in terms of sort of the income that is there, it's not just retirement income and government assistance. People in LA and low-income LA are working to pay their bills very late into life. And so there's income there, there's spending happening, they're competitive with the younger age brackets in terms of their financial transactions. So to disregard them as a market segment is a mistake. Finally, I'd make the point that sometimes we forget about this here in Los Angeles, that here in LA, the profile of your older unbanked Angelino, which sometimes we often think is, especially in South Los Angeles, some of our communities, is typically an older African-American segment. It's changed a little bit. You remember, the real face, according to our study, is an older Latino immigrant, and both Latino and immigrant. Majority Latino, from Mexico and Central American countries predominantly, majority foreign-born. That doesn't mean foreign-born got here yesterday. That means foreign-born been here 17, 25, 30 years, but still foreign-born, holding on to traditions. Overwhelmingly Spanish-speaking, not wanting to necessarily engage in English. Very much from LA and not going anywhere, but a very strong cultural identity and resonating with church, with home country holidays and events and icons. typically within walking distance of their financial provider, be it a bank or an alternative financial service provider, location, 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 and almost no comfort with computers. So, so some of the mass marketing, easily scalable, light touch tactics that I hear about, I don't think work with this segment. I think you're looking at trusted intermediaries and touching people where they're comfortable.